Hi, my name is Munir. I'm going to share on the corporate financial decision making on capital structure. What is capital structure? Capital structure is the combination of debt and equity used by a company to finance its operations and growth. These combinations comes from equity share capital, preference share capital, debentures, long-term loans, and retained earnings. Short-term debt is also considered to be part of the capital structure. There are few key components of capital structures, which is debt financing, equity financing, and hybrid securities. In terms of debt financing, it can be categorized into two, which is short-term debt and long-term debt. Short-term debt is loan and financial obligations due within 1 year. Long-term debt is loan and financial obligations due in more than 1 year, such as bonds and long-term loans. Second one is equity financing. It involves common equity and preferred equity. Common equity is funds that are raised by issuing common shares. Common shareholders have ownership in the company and voting rights, while the preferred equity is funds raised by equity preferred shares. Preferred shareholders usually do not have voting rights, but have a higher claim on assets and earnings than common shareholders. And the last one is hybrid securities. These are instruments that have features of both debt and equity, such as convertible bonds or preferred shares. Let's take a look at how capital structure applies in real company, which is Apple. In terms of equity capitalization, Apple's total stockholders' equity equated $71.93 billion as of December 2021. This consisted of $57.36 billion of common stock at par value and additional paid-in capital, and $5.56 billion in retained earnings. Apple had roughly 16 billion shares outstanding. And in terms of debt capitalization, Apple's liabilities as of year-end 2021 were $309.25 billion, consisting of $54.76 billion in accounts payable to come to a total current liability amount of $125.48 billion. Long-term debt and other non-current liabilities amounted to $287.91 billion. So moving on to the importance of capital structure. Understanding the significance of capital structure is crucial in navigating the complexities of corporate finance. It forms the foundation of a company's financial decisions, influencing its value, profitability, and flexibility. The importance of capital structure is increasing in value of the firm. A sound capital structure of company helps to increase the market price of shares and securities, which in turn lead to increase in the value of the firm. Second, utilizations of available funds. A good capital structure enables a business enterprise to utilize the available funds fully. Proper design capital structure ensures the determination of the financial requirements of the firm and raise the funds in such proportion from various sources for their best possible utilizations. And the third one is maximizations of return. A sound capital structure enables management to increase the profits of a company in the form of higher return to the equity shareholders. For example, increase in earnings per share. The fourth one is minimizations of cost of capital. A sound capital structure of any business enterprise maximizes shareholders' wealth through minimizations of the overall cost of capital. And the last one is in terms of financial flexibility. A balanced capital structure provides financial flexibility, allowing a company to take advantage of growth opportunities. So, how to determine the optimal capital structure? Determining the optimal capital structure involves balancing the mix of debt and equity to minimize the company's cost of capital and maximize its value. In other words, minimizes the weighted average cost of capital, which is WACC, of a company while maximizing its market value. The lower cost of capital, the greater the present value of the firm's future cash flows, which is discounted by the WACC. And as you can see from the example, when the WACC is 15%, the market value of the company is 667. And when the WACC falls to 10%, the market value of the company increases to 1,000. Hence, if we can change the capital structure to lower the WACC, we can then increase the market value of the company and thus increase the shareholders' wealth. Therefore, the search for the optimal capital structure becomes the search for the lowest WACC, because when the WACC is minimized, the value of the company's or shareholders' wealth is maximized. So it is the duty of all finance managers to find the optimal capital structure that will result in the lowest WACC. Next, factor affecting capital structure and capital structure decision. Factors that affect capital structure and capital structure decisions consist of sales growth, asset structure, liquidity, profitability, control, legal requirements, and cost of capital. For the sales growth is significantly influences a company's capital structure decisions. A rapid growth rate often necessitates additional assets to support increased sales and business development. The heightened funding requirements prompts companies to seek external sources of financing as their primary choice. Second one, asset structure. The composition of a company's assets, known as asset structure, also plays a crucial role in determining capital structure. Companies with high fixed assets ratio finds it easier to secure loans or external capital as they can pledge these assets to creditors. The third one, liquidity. Liquidity, or a company's ability to pay off long-term liabilities with its own assets, is another factor influencing capital structure. High liquidity levels indicate the company's capacity to settle current debt obligations without resorting to additional debt financing. Conversely, companies with low liquidity may need to rely more on debt to meet their financial obligations. And next is profitability. Profitability reflecting a company's earning from operational activities impact its capital structure decisions. Higher profits indicate sufficient internal capital to finance business activities, potentially reducing the reliance on the external debt financing. The fifth one is control. The consideration of maintaining control over the business is crucial in capital structure decisions. Equity shareholders may prefer debt capital over equity capital to avoid diluting their control, as debt financing does not grant voting rights. And the sixth one is legal requirements. Finance managers must adhere to legal provisions when designing a company's capital structure to ensure compliance with regulatory frameworks. And the last one is cost of capital. Generating sufficient revenue to meet the cost of capital and finance future growth is essential for business enterprises. Finance managers should carefully evaluate the cost associated with each source of funding when designing the company's capital structure. Now I'm going to explain on the financial distress. The financial distress is actually a situation where a company or individual cannot generate sufficient revenues or income, making it unable to meet or pay its financial obligations. In other words, if a company or individual experiences a period of time when it cannot pay its debt, bills, and other obligations by their due date, they are likely experiencing financial distress. So the factors contributing to financial distress are profitability, liquidity, size, growth, and risk. In terms of profitability, lower profitability will lead to higher level of financial distress that increases the chance to fall into bankruptcy. Thus, it implies that there is a negative relationship between profitability and financial distress. Bankruptcy happens when the firms which face financial distress are unable to finance their financial obligations. And then liquidity. Liquid assets are generally considered as backing against crisis, as they allow firms to save funds by not obliged to sell assets in unfavorable situations to pay their debt payments. Also, liquid assets enable firms to avoid the higher costs of other sources of funds to fund their activities and investment. In 2005, Weston, Butler, and Grolin discovered that fees charged by investment banks are lower to firms with more liquid equity. The study has resulted that financial distress costs are inversely related to the holding of liquid assets. The third one is size. Studies suggest that larger companies are less likely to default or face financial distress. This is because firm size is often associated with lower bankruptcy risk and more stable cash flows. Consequently, larger firms tend to use public debt more frequently and are considered less risky. Therefore, there is a negative relationship between financial distress and firm size. And the fourth one is growth. Companies with valuable future growth projects or intensive research and development avoid public debt to prevent high disclosure costs. High growth firms tend to use less debt financing, which reduces their risk of financial distress. Firms with significant growth opportunities are likely to maintain low-risk debt levels to avoid future financing problems, preferring not to finance investment with equity or passing on the investment. Therefore, there is a negative relationship between financial distress and growth, and leading to the fifth, which is risk. Firms with high business risks are less capable of sustaining financial risk and thus use less debt. Lower debt level imply lower financial distress. Empirical studies have shown that a negative relationship between risk and debt ratio. Therefore, there is a negative relationship between financial distress and risk. Moving on to the integration of tax effects and financial cost distress. According to the Modigliani and Miller M&M theorem, there is a relationship between a firm's value and its debt. The theorem states that the use of debt can increase the firm's value due to the interest tax shield, which is the savings from deducting interest payments. In the graph depicting the relationship, as the present value of the financial distress cost increases, so does the present value of the tax shield on debt. A company can benefit from using debt up to an optimal point because the tax shield from interest payments enhances the firm's value. However, beyond the optimal point, the value of the firm begins to decrease due to escalating costs associated with financial distress and potential bankruptcy. Thus, while debt can initially increase firm value, excessive debt can lead to higher bankruptcy costs, ultimately reducing the firm's value. Let's take a look at the agency cost of equity. So, what is actually agency cost of equity? It refers to the cost associated with resolving conflicts of interest between shareholders, which is principals, and company managers, which is agents. These conflicts arise because managers may not always act in the best interest of shareholders, potentially leading to inefficiency and reduced firm values. There are a few types of agency cost. The first one is monitoring cost, which is expenses related to overseeing the controlling managerial actions, such as costs incurred by the board of directors, audits, and implementing internal controls. The second one is bonding cost, which is costs managers incur to assure shareholders that they are working in their best interest, including contractual commitments, performance-based compensation, and restrictive covenants. And the third one is residual loss, the reduction in firm value that occurs even after monitoring and bonding costs due to managers' actions that are not perfectly aligned with shareholders' interest. Next, what are the causes of agency cost? In terms of information asymmetry, managers often have more information about the firm's operations and future prospects than shareholders, leading to potential misuse of the information. Managerial incentives, which is managers may pursue personal goals such as job securities, personal perks, or empire building, rather than focusing on maximizing shareholders' value. And the third one is risk aversion, where managers might be more risk averse than shareholders because their personal wealth and job security are tied to the firm's performance, leading them to avoid risky but potentially profitable projects. Next, the consequences of agency cost. It can be divided into three, which is suboptimal investment decisions, excessive perquisites, and inefficient capital structure. In terms of suboptimal investment decisions, managers may avoid profitable projects due to risk aversion or undertake projects that increase their power but do not add value to the firm. The second one is excessive perquisites, where managers might spend company resources on personal benefits like luxury offices or corporate jets, rather than reinvesting in the business. And the last one, in terms of inefficient capital structure, managers may prefer using internal financing over debt to avoid the scrutiny and pressure from debt holders, potentially leading to an inefficient capital structure. How to mitigate agency cost? There are a few ways which involve corporate governance, compensation policies, market mechanisms, and debt financing. In terms of corporate governance, it can be categorized into two, which is board of directors and shareholders activism. So in terms of board of directors, an effective and independent board can provide oversight and align managerial actions with shareholder interest, while for the shareholders activism, active shareholders can influence management decisions and push for changes that enhance value. Second one, compensation policies, were categorized into two, which is performance-based pay and equity ownership. In terms of performance-based pay, linking managerial compensation to firm performance through stock options, bonuses, and profit sharing can align interest. And next, equity ownership, encouraging managers to own shares in the company can make them more invested in the company's success. The third one is market mechanisms. Market for corporate control. The threat of takeover can discipline managers as underperforming firms are more likely to be acquired. And second one, labor market for managers, which is reputational concerns in the managerial labor market can motivate managers to act in shareholders' best interest to secure future career opportunities. And the last one is debt financing. Using debt can reduce free cash flow available to managers, thereby limiting their ability to engage in self-serving behavior. However, this must be balanced against the risk of financial distress. Moving on to the pecking order theory. What is the pecking order theory? Pecking order theory is a financial theory proposed by Myers and Maslov in 1984. It suggests that companies prioritize their sources of financing according to the principle of least effort or resistance, preferring to use internal financing first, then debt, and raising equity as a last result. This theory helps explain the capital structure choices firms make and observe financing behaviors of companies. There are a few key concepts of pecking order theory. The first one is internal financing first. Firms prefer to use internal funds, which is retained earnings, for financing because they involve no issuance cost and no need to disclose private information to external parties. Using internal funds avoids the adverse selection problem where managers have more information about the firm's value and prospects than outside investors. Second one is debt as a secondary option. When internal funds are insufficient, firms will issue debt. Debt financing is preferred over equity because it typically has lower issuance costs and less impact on ownership structure. Debt signals confidence to investors, as managers would only issue debt if they believe the firm can handle the associated interest payments. The third one is equity as a last resort. Issuing new equity is considered the least preferred option because of higher issuance cost and the potential for significant adverse selection problems. Equity issuance can signal to the market that managers believe the firm is overvalued, potentially leading to a decrease in stock price. So, what is the rationale behind this theory? In terms of information asymmetry, managers generally have better information about the firm's value and future prospects than outside investors. This information asymmetry makes external financing more costly. Internal funds are preferred because they do not require firms to reveal information that could adversely affect their market valuation. The next one is cost of financing. Internal funds are the cheapest form of financing since there are no issuance costs or required returns to outside investors. Debt is cheaper than equity due to the lower issuance cost and tax deductibility of interest payments. Equity is the most expensive form of financing due to higher issuance cost, dilution of ownership, and the potential negative market reaction. Next, the implications of the pecking order theory. The first one is capital structure. Firms with ample internal funds will have low levels of debt and equity issuance, while firms with insufficient internal funds will resort to debt financing before considering equity financing. Next is financial flexibility. Firms maintain financial flexibility by keeping debt levels moderate to ensure they can access debt markets when needed. Retained earnings serve as a buffer, allowing firms to finance new investments without immediate reliance on external financing. And the third one is market reactions. Market reacts differently to announcements of financial decisions. Debt issuance might be seen as a positive signal of confidence, while equity issuance can be perceived negatively. Next one, signaling hypothesis. What is signaling hypothesis? The signaling hypothesis is a theory in finance that examines how firms use specific actions or signals to convey private information to investors. The signaling hypothesis helps us understand how companies can communicate with investors. It is based on two main ideas, which is information in terms of information asymmetry and costly equity issuance. The first one, information asymmetry. Firms possess private information that investors lack, leading to uncertainty and potential undervaluation of securities. Costly signals are employed to reduce information asymmetry by providing investors with credible insights into the firm's prospects. The second one, costly equity issuance. Selling equity can signal to investors that shares are overvalued, leading to a negative market reaction. Companies avoid equity issuance to prevent signaling that the stock price is inflated. As such, actions may result in stock price declines. Moving on to effect of signaling hypothesis. The signaling hypothesis also affects how the market reacts and the choices companies make about their finances. The first effect is effect on market reaction. When companies sell more stock, it often makes investors worry that the stock is too expensive, so the stock price might go down. Next, in terms of capital structure choices, instead of selling more stock, Companies might choose to borrow more money instead. This way, they don't send a signal that their stock is too expensive. So in conclusion, understanding capital structure is crucial for optimizing a company's financial strategy, balancing debt and equity to enhance market value, minimize risk, and achieve long-term growth. That's all from me. Thank you.